Hello, everybody. Today we're going to look at the history and the evolution of banking. Now, it's a potted history, of course, because we're only going to spend a few minutes talking about it, but I'm hoping to give you a good flavor of the history and evolution of banking and also a look at what we think might be trends for the future. Okay. So the common view of a bank is what you see here. There's a banking hall. There's Roman style pillars outside. That's a traditional image of a bank. Of course, these days many banks don't even have physical presence that the customer can go to. But that's a separate issue. We'll discuss that maybe a bit later. What is the history of banking? In fact, where does the word bank come from? Now, the word bank comes from the old High German word bank, or BANC. I'm not sure if that's pronounced correctly, which means bench or counter. Apparently, according to Google, it was brought into Middle English from Middle French as banque, Banque, and then from Old Italian also as banco, which also means table. And why is this the word used? Because originally the money lenders would sit on a bench, so we literally mean a bench, and they'd have their counting machine, their money counter there, and that's where they would be doing business from this bench. Hence the word bank. Okay, now when I first read about this many years ago, I thought that seemed a bit too almost legendary, almost apocryphal a tale. But when I've looked into it across a number of other sources, it genuinely is that case. Money lenders and deposit takers would sit on this bench and they would conduct their business from that, and they'd have their money counters with them on the table. So hence, bonk or banco or bank became bank as we understand it today. Okay, again, according to Google searches, during the Renaissance, during the Middle Age, or post-Middle Age Renaissance, Florentine bankers used benches as makeshift desks or exchange counters for their transactions. That's where I'd read elsewhere, outside of Google, a Google search, that money counters, traditional counters, would be on the tables next to them. Okay, and according to one history I read, this is also a Google search, they would cover their desks with green tablecloths. That's a little bit of sideline history that you may or may not be interested in. So when was it used as a noun from the Middle Ages? So let's say 12th, 13th century. Also used as a verb, to bank, and that dates from the 15th century. Now that might seem a long time ago, but actually it's not that long in the history of commerce, of exchange. Coinage, as we recognize it, dates from Roman times and even before, as you know. So commerce using money in a style of fiat currency, like say Roman coins in the Roman age, was with us a couple of thousand years before that. And modern banking dates from this period, from this European Renaissance period. There's a couple of banks around today that can trace their history back to the 15th century. Well, there's at least one Italian bank called Montepaschi di Siena. Interestingly enough, I remember when I was at JP Morgan many years ago working on one of their securitization transactions. They were our customer. Montepaschi di Siena, that they date from 1472. That's 20 years before Christopher Columbus discovered the Americas. So from the 15th century, there's a bank in Austria called Berenberg Bank, which dates from 1509, can trace its history in its original form, as it is still now, back to the beginning of the 16th century. Bank of Scotland, which doesn't exist today as an independent entity, it was founded in 1695, so the end of the 17th century, and actually was one of a groundbreaking institution if you read the history of that bank, because in the nature of the type of products it introduced. So that's possibly a subject for a separate video, actually, the history of Scottish banking. A lot of what we would today call innovation in finance came about through those two Scottish banks, Bank of Scotland and a bank that was formed a few years after that, the Royal Bank of Scotland. And hit today in 2024, neither of those names exist as independent entities, but I don't want to talk about that. Right. Okay. So banking history, modern banking as we recognize it today, dates from the 15th century at least, and it would have been something that we'd been familiar with from a couple of hundred years before that. So that's the history of banking, a potted history of banking, and that tradition, the concept of banking, the business model, the operating model of the bank, that's been transported around the world. So what started out in Western Europe in the the later Middle Ages, the Renaissance period the Renaissance period in Western Europe was transported as an operating model around the world, and we see exactly that same operating model in use in banks around the world today, in just about every country in the world. So, in human historical terms, it's relatively recent. In modern history terms, it's at least a 500-year-old line of business or line of commerce. So, what do banks do? Well, banks lend money and they take in deposits. I've got a nice little illustration of a bank using the traditional Roman columns, if you like, to illustrate the bank. And I show in this illustration the bank. I show its interaction with other banks. I show its interaction with customers. And customers come in two types: borrowing customers, those who want to borrow money, and lending customers, those who deposit money with the bank. Often the bank will be, often a customer will be both. They will be both borrowers and lenders of their banking service provider. And if you look at my illustration at the top, there is the central bank, because today, and this is much more modern actually, central banking as we recognize it today as a supervision authority, as a lender of last resort, that only dates from the end of the 19th, early 20th century onwards. So that's actually much more recent than the history of privately owned commercial banks. But today we'd put the central bank at the top of the illustration because all banks clear, if you like, or settle, and they place reserves with the central bank of the country that they're domiciled in. So today we'd include the central bank. But if I was doing this video, probably difficult 200 years ago. They wouldn't have had video technology. But if I was doing this presentation 200 years ago, I wouldn't have the central bank there because it was possible to conduct business without having any interaction with the central bank whatsoever. But in modern times, so let's say from the 20th century onwards, early 20th century onwards, that's not been the case. Hence the central bank in my illustration. So if you turn to page 5, assuming you have it, if you don't, I'll just read it to you, no problem. My textbook, The Principles of Banking, the second edition of The Principles of Banking. If you turn to page 5 of that, I've got my own personal definition. I write, we need to define banking first. Okay, it's page 5, so it starts quite early on. Banking is the art of making loans to individual and or corporate customers whilst simultaneously accepting deposits from individual and or corporate customers. And this is the crucial bit, of retaining and managing those transactions, those money transactions, on the bank's own balance sheet. Okay, that's my definition of banking. And the reason I call it an art is because it is an art. It is an art. One has to make a number of assumptions if one is to think I can provide banking services. And that's why it's as much art as science. Okay, and that's something we could maybe cover in a separate video. So that's the history of banking, and that's what banks do. That is the definition of banking. They undertake loan activities, they lend money to their customers, and they take in deposits from their customers. And some customers will operate only on one side of that equation. They'll only be borrowing customers, and some customers will only be deposit customers, and some customers will be both. Think of your own bank. You have a current account with them, and you may well have a credit card from the same bank, as well as a savings account, perhaps even a mortgage. So you're a customer on both sides of their balance sheet. So that's banking. That's what they do. Today, if you look for a definition of a bank, you'll probably see some other some addition to that, some nuance, some additional text. Banks today might provide other services. More and more of them do these days, and beyond just lending and deposit taking. But that's my original, that's my simple definition of a bank. If you don't do those simple things, then you're not a bank. You might do some of the other things that banks do, but then in my definition, you'd be a non-bank financial institution, because what banks do first and foremost is accept deposits and hold that deposit in trust on your behalf until you want the money back, and they lend money. And again, reiterate, the critical part is they manage those two transactions on their own balance sheet. They don't pass it off to someone else. They're not brokers. And again, another critical part of the definition, they don't have to match both sides of the transaction for it to happen. When you go to borrow money from a bank, they don't need to have someone on the other side who is depositing exactly the same amount of money for the same term. They do need to fund it. We'll come to that later, but they don't have to match the transaction. They're not brokers and they're not agents. That's my personal view, my personal definition. The critical part is they maintain the transactions that they undertake with their customers on their own balance sheet, and they manage that accordingly. They're not agents. They deal with you direct on their behalf, and they're not brokers. They don't broke with the other side of the balance sheet. Okay, so that separates a banking institution from other non-bank financial institutions. Okay, what else? The orthodox banking business model. Again, I would quote you from my book, but let's just say it's chapter 1 of the Principles of Banking. The orthodox banking business model basically relies, well, it's based on 5 key concepts, okay, the orthodox traditional banking business model. And this would have been the case from the 15th century onwards. This hasn't changed. It's the same as it's always been. 5 key concepts. They are capital and leverage, the gap or mismatch, the yield curve or the existence, the idea of a yield curve, liquidity, and credit risk management. Those 5 key concepts. Let's quickly go through each of those. Capital and leverage. Banks, as legal entities, as corporate institutions, they have their own shareholder capital. The owners of the firm have invested their own equity in that legal entity. However, banks don't lend, not generally and not in the main, their own money. They lend other people's money. They borrow money from deposit customers or from the wholesale markets or from the institutional investor markets or sometimes even from their central bank. They borrow money and they lend that money. In other words, they lever up their balance sheet, they lever up the capital base that they have to create a bigger balance sheet, and that borrowed money is what they lend to their loan customers. Okay, so capital and leverage. The second concept, I called it the gap or the mismatch. Remember what I said earlier, banks don't have to match the transaction. If you want to borrow £100 or £1,000 or £1,000,000 for 1 year or 1 day or 10 years, to do that transaction, they don't have to match the other side. They don't have to match the amount or the term or the interest rate basis. So the fact that they are lending money for longer periods and taking deposits for shorter periods generates what I call the gap, the funding gap or the mismatch, because loans are generally longer dated. I mean, you wouldn't borrow money for a day or a week. Well, not from a bank, not generally. Loans are generally longer dated in terms of when the money will be paid back. And deposits are generally shorter dated. Think of your instant access deposit account. You can take your money out at any time on the same day. So contractually, that's a 1 day or a 0 day, an overnight deposit. So this creates this funding gap or mismatch. That's the second concept. This leads on to the third concept, which is probably a subset of that second concept, which I'd call the yield curve. When I lend money for a longer period and I take in deposits, one thing I haven't mentioned yet, but I'll mention it now, the interest rate. Money has time value. Money doesn't change hands for different periods of time at no cost. If you borrow money, you pay interest on it. And if you deposit money, you will expect to receive interest on it for most types of deposit. And that interest rate differs depending on the term of the transaction. If you borrow money for 10 years, you could probably expect to pay a higher interest rate than if you were borrowing money for just 1 year or 6 months. That's conventional market dynamics, and that creates a yield curve. In other words, the interest rate payable or receivable for overnight borrowing of money will be lower than the interest rate payable or receivable for borrowing or lending over 1, 3, 5, 10, 20, and 50 years, generally speaking. And that gives us a yield curve. And in an orthodox or conventional economic environment, that yield curve will have a positive slope. But that's probably a topic for another video. The fourth concept, liquidity. One has to assume that one can always borrow money if one is a bank. Think about it. If one didn't make that assumption or have that confidence or comfort that one could always borrow money, one wouldn't lend money for long periods of time. Think of a residential mortgage. Contractually speaking, a 25-year loan. You lend money to somebody to buy their house, they're going to pay it back over a 25-year period. So you've lent money that you're not going to get back. Let's make a simple assumption that it's not a repayment mortgage, it's a bullet mortgage. Okay, you don't get those very often, but they do exist. Let's imagine you lend money to someone for 25 years and you're going to get it back in 25 years' time. You've got to, in other words, fund that loan because you've borrowed money to lend it in the first place. So you've got what I'm going to call now a liquidity risk exposure, because you've got to keep the loan funded for 25 years, but the person who deposited the money with you may want it back at any time. So just imagine if you took in an instant access deposit, £100 worth of that, and you lent that for 25 years, you've got to make sure you've got that £100 available to return to the depositor at any time. This, in essence, is liquidity and funding risk. That's liquidity risk. And you'd have to assume you can always borrow money, because the minute you can't borrow money, if it's at the same time that the depositor wants their money back, you're going to be out of business. You're going to be out of luck. You're going to be bust. Okay. So we assume continuous liquidity, but because we know that that's a strong assumption, we take various steps to manage that liquidity risk, as I'll call it now. But that's a key concept in banking. the concept, the assumption of continuous liquidity, and the acknowledgement that I expose myself to liquidity risk every time I make a loan using funds that I've borrowed from other people. And then finally, the fifth concept is risk management, particularly credit risk management. What's the biggest risk that any bank will run at any one time? Think, what's the risk you run when you lend somebody money? The risk that they don't repay it. And if they don't repay it, that money is going to come out of your capital base because you still owe the depositor their money back whenever they want it. So a default on a loan is going to cost you money. It's going to cost the shareholders money, their equity base. So a key concept in the orthodox banking business model is understanding default risk, or credit risk as we'll call it now, and managing that accordingly. So those are 5 key concepts in banking. So that was history of the evolution of banking in just a nutshell, and also the orthodox banking business model in a nutshell. Hope you've enjoyed that. I will speak to you soon in the next video. Enjoy. See you soon. Bye.